Let's get right into it. The data is screaming that we are sleepwalking into the biggest energy supply shock in modern history. The entire global economic story is completely fractured. And here's why. We're talking about a staggering 20 million barrels of oil per day, just gone, choked off at the Strait of Hormuz. To put that in perspective for you, that's nearly 20% of everything the world consumes, every single day. And yet, what's Wall Street doing? They're blindly cheering for the S&P to hit, get this, 7,800. It's completely divorced from reality, because the reality is a world with $120 crude oil forces the Fed into a corner. And guess what? Those rate cuts everyone was promised? Yeah, they're gone, wiped off the table. So today, we're going to expose what we're calling the normalization trap. It's about to wipe out unprepared portfolios. And we're not just going to leave you there. We'll show you the exact hard asset strategies the smart money is quietly piling into right now. All right, Section 1, the 2026 market paradox. To really get a handle on this trap, you first have to see the paradox at play. Let's start with Wall Street side of the story. Their incredibly bullish case for 2026. Take a look at this. What's really wild is that it's not just one bank. It's everyone. Morgan Stanley, Deutsche Bank, HSBC, they are all singing from the same hymn sheet. They're all calling for this massive continued bull market, pointing to earnings, buybacks, and of course the AI boom. And this quote from Morgan Stanley's strategist really gets to the heart of it. They believe there's this perfect storm, this triumvirate of good policy that lets the market basically just ignore all the scary macro stuff and focus only on the shiny new joy, the AI investment story. And this chart, it's the perfect picture of that U.S. exceptionalism narrative everyone's pushing. You've got Goldman Sachs projecting U.S. growth at a healthy 2.6%, while Europe is sluggish and Japan is basically flat. This is the consensus. This is the story they want you to believe. But it is only half the story. Okay, real quick, before we dive into the other half of this story, this standard disclaimer, everything you're about to hear is for educational purposes only. It is not investment advice. Please always do your own research. All right, Section 2, an unprecedented energy shock. Now, let's talk about the other side of this paradox, the part that's a geopolitical nightmare, the part that shatters that whole optimistic view. And it all comes down to this one spot on the map, the Strait of Hormuz. You have to understand, this isn't just some shipping lane, it's the jugular vein of the global energy economy. We're talking about a fifth of the world's oil and a fifth of its LNG, all squeezing through this one tiny choke point. And in this scenario, for March 2026, it gets shut down. Look at how fast this escalates. Military operations start on February 28th. By March 2nd, Iran closes the strait. And just a few days later, Brent crude rockets past $100 a barrel, eventually peaking near 126. It's shockingly fast. I mean, this chart just shows you how violent that move is. We go from a calm $73 a barrel to over 120 in days. This isn't your typical gradual price creep. No, this is an economic shockwave. It hits everything, everywhere, all at once. And the sheer scale, it's just mind-boggling. With tankers literally trapped, global producers are forced to slash output by 10 million barrels a day. The IEA, the official scorekeeper for this stuff, they've called it the single largest supply disruption in history. Not in a decade, in history. Okay, so Section 3, the normalization trap explained. You're probably asking, how can these two things exist at the same time? Wall Street's party on one side and this brutal reality on the other. Well, to understand that, we have to talk about a really dangerous psychological trap that investors are falling into right now. It's called the normalization trap, and a firm called Control Risks has a great definition for it. Basically, it's when we get so used to chaos and volatility that we start to think we're ready for it. We mistake just getting by for being genuinely prepared. It's like living in a house with a leaky roof for so long, you forget what it's like to be dry, and you stop trying to fix the hole. Because this is the new normal. Volatility isn't a blip on the radar anymore, it is the radar. The old playbook of planning for one crisis at a time, it's completely useless. We're in a no-rules world now, where you get an energy shock, an inflation crisis, and a supply chain disaster all hitting you at the same time. That's the new baseline. And this is the key takeaway, the most crucial point. The era of just blindly piling into big tech is over. done. The money, the capital has violently shifted. It's moving away from the AI builders, the big tech giants, and into the AI adopters, the real-world companies that are actually putting this tech to use. Look, if you want to get ahead of these massive institutional shifts before the rest of the market catches on, you need to hit that subscribe button right now. We're all about analyzing the data that the mainstream media just completely ignores. Okay, Section 4, navigating the new reality. So let's connect the dots here. Let's bring Wall Street's dream world and the physical reality together and see what kind of investment landscape that creates. Because this is where the trap snaps shut. It's simple, really. You can't have the AI dream without the physical reality. The data shows it clearly. For every shiny new data center and brilliant algorithm, you need the boring stuff, the power grid to run it, the copper to connect it, the actual infrastructure to house it. One cannot exist without the other. They're two sides of the same coin. And this just perfectly illustrates how fragmented the world has become. You've got the Fed over here, trying to fight inflation by keeping rates high. Meanwhile, the ECB is basically frozen, terrified of stagflation. And then you have the Bank of Japan being forced to hike rates aggressively. Everyone's doing something different. The world's central banks are not on the same page, and that is creating massive distortions in the market. Okay, so at the very beginning, I promised you the secret to surviving this 2026 stagflation trap. Well, here it is. The secret isn't about outsmarting the Fed or timing the market. It's much simpler. You have to own the physical bottlenecks of the future. That's where the smart money is going. They are cornering the supply of copper. They are investing in the power grid. They're buying up the real-world stuff that the entire AI dream depends on. So, if you want to understand just how high copper and silver prices are projected to squeeze in this new reality, you need to click the video right there on your screen. It's our deep dive into the 2026 commodities supercycle. You have to see it, because the data never lies.